I want to say a little bit about my own journey into public service. I was not a little girl who thought someday I want to be president or someday I want to be senator. I was actually a little girl who did have aspirations, ambitions. I wanted to be a school teacher, and it was pretty cool. And the journey that took me here is the most improbable of journeys. I was someone, I married at 19. I had my first baby at 21. I started law school on Amelia's second birthday. It was a big event. I kept explaining to her about how Mommy was going to go to school and she was going to go to school, and potty training was the thing that stood between us and success, and we got there together. And so all this ended up, I went from being a public school teacher to going to law school with one little one, spent a summer on Wall Street, my second summer of law school, taking the train. I remember how serious I felt. I would get on the train with all these men to ride into Wall Street. We were living out in New Jersey. And I got pregnant my third year in law school, graduated from law school, enormous, and didn't take a job because you couldn't get a job if you were pregnant. I thought that the 3 years I'd spent in law school were gone. I'd stepped off the career track, a career track that was really not open to women. And I thought I'd given it all up because I was now going to be home with 2 babies. And I went ahead, took the bar exam. I was the first nursing mother to take a bar exam in the state of New Jersey. Try explaining that 1,000 times to the proctors. But we made it through, and I actually went into solo law practice. I still have a shingle that says, black with white letters on it, Elizabeth Warren, and then in italics, attorney at law. It still hangs on my wall because it meant about you pull yourself up and you do what you can. My law school, Rutgers, called me back to teach, so I really was going to get to be a school teacher again. One thing led to another, and I ended up with a permanent teaching job down in Houston, where my husband had been transferred. And there I was. I was a young mother. I had 2 little kids. I was struggling with daycare, trying to figure out. I was one of those people who lived out in the suburbs, and I passed. I was teaching at the University of Houston. When people would ask me if I worked, I would always say, yes, I teach. And they'd say, what? And I'd say, first years. To which people would say, oh, they're so cute at that age. And I'd always just smile. They are. It's true. And there I was in an all-male environment. It was then an all-male profession. And I had picked out an all-male area that I like to work in, which is commercial and business law, where the money is. And so here I am struggling to teach. I'm reading the stuff, trying to stay just about a half a step ahead of my students. And I knew that I had to do research. I'd be perfectly honest, not having grown up in a very fancy law school or a very fancy undergraduate school, I wasn't entirely sure what it was all about. Other than I'd seen a little of it when I'd been on Law Review, a little of what you needed to piece together. So I thought you need a question to look at and to start doing some research on how it works. And there was a new law in place, the new bankruptcy laws, and I thought, I know what I'll look into. Who files for bankruptcy and why? There was a lot of conversation just starting. Remember, this is the early 1980s, late 70s, early 1980s. That it was unscrupulous people who were taking advantage, running up bills and then dashing into bankruptcy and discharging them. And that's how I got started in my first bit of research and my first empirical studies. And it turned out to be a very sobering journal. journey, because where I ended up was in a world in which, let's just start right there when I was at the beginning getting started. Bankruptcy filings over the next 20 years doubled and doubled again and went up again. We reached a point where women in that period of time, over a 20-year period, the increase in the number of women filing for bankruptcy went up 662%. By the early 2000s, an adult woman was more likely to file for bankruptcy than she was to graduate from college. For many people, and I should point out about this, and women with children, about 4 times more likely to file for bankruptcy than those without children, than married couples, than men. So what did that mean? Chronic poverty issues, is that what we're talking about? No, actually we weren't. In the mix of women, of married couples, of single men who filed for bankruptcy, by and large it was a profoundly middle-class group. As a group, compared with the rest of the population, folks in bankruptcy had gone to college, they'd gotten decent jobs, they'd bought homes, many of them had started families, and yet something had gone terribly wrong in their lives. So wrong that we reached a point that now more than 1 million families every year find themselves in bankruptcy. So this led me, I started my studies with bankruptcy and then just kept working backwards. How much it's happening, to whom it's happening. America's middle class, what has gone so profoundly wrong that would cause so many families to file for bankruptcy? And keep in mind, for every family in bankruptcy, there are many more tottering right on the edge, not having filed, put it off, as more than one family who ended up in one of our studies committing suicide rather than taking that step. So bankruptcy becomes a little like like in medicine, the notion we will dissect the bodies to discover where illness is in the population generally. And that's basically what I did with the bankruptcy data, just kept backing it up on who's there. And basically, here was the story that unfolded. It's a pretty straightforward story. The American middle class has been hit by a 1-2-3 punch. The first one, rising core expenses. You know, every time someone does adjusted for inflation, unpack those numbers and look at the parts that are flexible spending, the kind of things you can cut back on if somebody loses a job or you're a little tight this month, and look at the part that's relentless, the big core fixed expenses that happen month after month. Mortgage, health care, transportation expenses, child care if you have young children or are trying to work. These were the expenses that went up for families, while families cut back on everything else, on food, on clothing, on appliances, on furniture. It was not the picture of overconsumption that you read about in books like Luxury Fever or The Overspent American. It was a picture of families who did everything they could to cut back on expenses. But over time, what was happening is the core fixed expenses, the kind of expenses that make us middle class, health insurance that you can count on if someone gets sick, a mortgage on a home. And let me point out, for those of you who are sitting there saying, but homes got bigger, got fancier, spa bathrooms and granite countertops, we're talking about median families here. For the median family in the United States in this same time period, houses got about 10% bigger and they got 25 years older. The typical family over this one generation period, this 20-year period, 25-year period, picked up either a second bathroom or a third bedroom, but not both. So at the median, what we're talking about are families who paid much more just to hang on to what was the typical place in the middle class. That's number one. Number two is they just got hit with flat wages. You know, if we drew a picture of what wages look like in the United States and we mapped it against GDP, if I'd known we had a great screen, I actually would have brought my slides on this, and then you all could have rested. I know what students are like. So you start post-World War II, and basically what happens is GDP and inflation-adjusted wages just move together. In other words, what's happening is every year that goes by, the pie is getting bigger. And so the slice that goes to wages, the part that we get to eat, that, you know, buys our houses and pays for our health insurance, is bigger because it's a proportionate piece of an ever bigger pie. And you start somewhere around the mid to late 70s, and the two curves start to diverge. And GDP, God bless it, takes a sharper upward trajectory, and a fully employed male flatlines. So that today, a fully employed male in the United States, median earner, adjusted for inflation, makes less than his father made a generation ago. That's what happened on the wage front. Families responded by doing the typical things. They quit saving. They sent a second earner, if they had a second earner, into the workforce, so they became two-income families wherever they could. And now here comes the real third punch. They turned to debt. It just happens that in 1980, basically, we can go through the details, we deregulated the credit industry. So if you think of consumer credit, right, whether it's mortgages, credit cards, short-term cash loans, car loans, whatever you're talking about, let me just explain it this way. There are 3 time periods in the world on consumer credit. The first time period goes from the 14th century BC Code of Hammurabi. Really? Usury. There shall be no usury, right? And we put usury caps in place. If you think about it, it's the very first consumer protection that I know of in the history of humankind. So, usury laws. That period extends to 1980. Yep. In 1980, with no public debate, and I'm glad to do the details, but effectively, we pretty much repealed the usury laws. We kind of did it in 2 bites and no real debate over it, got rid of them. And that started the period from 1980 to 2010. And that was the period, in effect, of the Wild West. And what happened during that period is that we ended up with families at the very moment that they were turning to debt in order to pay for college educations, something that had, another one I should have mentioned in terms of costs rising significantly. At the same moment that they turned to debt to deal with medical problems that they couldn't pay for. At the same moment that they turned to debt to deal with unemployment. At the same moment that they turned to debt just to try to make it to the end of the month, the debt industry became far more dangerous than it had ever been in our history. So here's what happened. It used to be the case that creditors effectively screened their borrowers. They looked at them to see if they thought there was a pretty good likelihood they would repay. And they said, in effect, we'll figure out our business model based on that. We'll screen the borrowers carefully. We charge a premium for risk. We charge something for the time value of money. We put something in for the risk of inflation. We put a little something in for our profits. And we're done. That's what the business is about. And people who are good at screening will do well in this business, and people who are bad at it, in either direction, will be washed out of the industry. It was really a very virtuous cycle in terms of reinforcing itself. But there were lenders who figured out a very different model. And that was a model that said, wait a minute, we think there's a better way to make the profits. We can make profits on penalty rates. We can make profits on repricing. We can make profits on fees. In fact, we can make such extraordinary profits if we set this up right that we actually can make a profit even if you end up defaulting on the loan. We can make so much money in the upfront, particularly at a time over the last few years when the cost of funds was very low. We can make so much money that we will be repaid on extraordinarily risky loans. We'll make our money back after a few months and shoot. The rest is just an annuity. Just count on raking in the money. So what happened after a while was that we ended up with a credit industry that fundamentally changed. And it changed in the following way. In the same way that I described a fairly virtuous circle that was pretty easy to understand, it switched over to a market in which it was all about upfront marketing, is pretending to sell at a low, low price, knowing that if I can get you in the door, I will be able to extract incredible fees and repricing on the interest rates so that I will make all my money on the back end. So it becomes a front end, back end game to get people in the door. And that meant obscuring costs for the customer, making these ever more complicated arrangements so that it's very difficult to compare one product to another. What happened? Credit cards led the way. A credit card agreement, Bank of America's credit card agreement in 1980 was just a little under a page and a half long. That was the whole deal, the entire contract. That ballooned to an average of about 30 pages a couple of years ago. 30 pages of what the industry refers to as mice type. Words that are designed not to be read. No, I mean, that's the point. Let's just be serious. Look at it. What does it scream? Do not read me. You could die if you read this. We will kill brain cells, anyone who enters here, right? It's written obscurely, it's written in small language, it's written in long sentences, everything to obscure what the arrangement is about. And I want to make a little point off to the side about all of the fine print, as we've come to call it, that's been put in these contracts. Great place to hide things, right? It's like shrubbery for the muggers. Who knows what's back there? Most of it's probably perfectly benign, but you can't tell. And that's really the point. Slip in a clause here, add a little penalty fee over there, an extra expense over here, and it's all lost in a sea of words, words, words. Credit card companies weren't the only ones, though. Others began to follow. The idea of a teaser rate credit card, we will give it away for free, right, or almost free, 2.99%. You've seen these over and over, gave way after a few years to a teaser rate mortgage. The idea that we will lend you a mortgage that we know, based on the financial information you have given us, will at the end of 2 years cost you your home if you are unable to refinance this mortgage and pay additional thousands of dollars of fees. And that was a business model that was enormously profitable. Now, I want to be clear as we go through this, when we talk about what went wrong in this industry and what's gone wrong in the last decade. There's plenty of room to talk about borrower irresponsibility as well. Borrowers took on too much credit. There's no doubt about that. And in some cases, it was people who were heedless. It was people who said, you know, I'm going to the mall. I got plastic. As long as they'll give it to me, I'm going to go spend it. But we have to keep in mind that this was an era in which ordinary market competition simply did not work. Credit card tricks and traps generated millions, generated billions of dollars for the issuers. And risky mortgages injected so much risk into the economy, it nearly brought us to our knees. There was an industry that profited beyond all dreams in selling people on borrowing money. And so were we fallible? Yes, we were fallible. But there were people who made billions from taking advantage of our fallibility. So this is where we were a few years ago. I looked around and I have to tell you, I was terrified. 2003, I wrote The Two Income Trap. 2004, I wrote a book on financial advice, All You're Worth. I was starting to do blogs about the coming crisis, the collapse, what was going to happen. And I thought, you know, this is no good. My only tool, I really felt this way about it. I felt like someone who raged at the wind, and I thought, this is crazy. If I'm going to expend this much energy, I need to find a way to make it have a difference. Yelling is not working here. So back up and find something else to do. And I came up with an idea. God, I thought this was a good idea. Not the agency, it's something else. It was called Clean Cards. Isn't that a cool name? So what Clean Cards was about, here was the idea behind it. My theory was we'd start with credit cards. It was the most obvious place. It was the product people were using on a regular basis. You didn't have to wait till you caught people who happened to be buying homes. You didn't have all the complications. I thought this will be the tip on the spear and the way to think about this. And what we'll do with clean cards is we'll set up a group that will be sort of the people of integrity, people who might be recognizable to other people, who will say collectively, we will certify that this is a clean credit card. And here's what clean credit card means. It's like a good housekeeping seal of approval or underwriter's laboratory. Long before this was done in government, right? The idea that someone would say, we looked at this and it's safe. And here's all I was looking for safe, is that the costs and risks were clear up front. There was no icky, creepy stuff hidden in the fine print. That was basically all you had to commit to. You could charge whatever you wanted and get a clean card if you would simply do upfront pricing where somebody could see it. You made the price clear in advance and then agreed that you wouldn't put junk in the back and we would read it to make sure you didn't put junk in the back. And so as long as you were holding the clean card designation on your credit card, you could go ahead and you would charge anything you want. So I talked to some various folks about this. Pew Charitable Trust said they thought this was a great idea, and they put up a lot of money that was well spent. And here's how it was well spent. This is true. They hired one of the fanciest bank consulting companies, basically to sit down with me and a few other folks they'd gotten together to walk through how credit card profitability worked, walk through the terms, walk through what had been put in, how they'd changed, showing us the competitiveness of the industry and so on, so that we could frame it right. And this really was, getting to go back to college, right? Going to college on credit cards 101 on someone else's nickel. So we got this all together, and they hired someone who was very well respected, who'd recently retired from the industry, who's now in the witness protection program. And we went out and we paid calls on, all I can say is, thanks to the confidentiality agreements, on executives in companies whose names you would recognize. So we go out, and I want to tell you how these went. We had exactly the same experience repeated. So the first one would be we'd show up and kind of explain clean cards. And listen, competitive industry. Everybody wanted those credit card customers. Understand that. It was competitive in the sense that they were desperate to get you to use their card instead of someone else's card because they'd figured out how to make these cards so incredibly profitable on the back end. So I learned things like, getting it to top of wallet and cross-selling and all these things. So getting customers in, enormously valuable to these companies. So we said, in effect, you can have the clean card seal to put on your card. And think of it this way. You'll be the one. You'll be America's finest bank. Your CEO will have his, and they were always his, picture up on the cover of Business Week at a minimum, Newsweek if you're lucky. And you could see them. This was cool, right? So people were, how this might work. We might have to take a little trim here, blah, blah, blah. So it worked. We get invited back for the second one, and we've moved up the food chain to fancier people at the company. Second visit goes very well. They actually generally served refreshments. I measure by these things. And people are getting enthusiastic. They're asking more details. Well, could we still keep our brass knuckles? Yeah, you could still keep your brass knuckles. And we'd have back, could we still do that? Well, I'm not sure you could do that. So we'd talk back and forth about what you could and couldn't do. I mean, they're starting to get serious, at least about the basic outline of how this thing works. Some real enthusiasm. We want to talk to you. Go back for the third visit. And the third visit, no refreshments, was always, we're not interested. We're not going to do this. And I was walking out with the guy who put his arm around my shoulder. And he said, I get that what we're doing is unsustainable over the long haul. We can't keep this up. Americans can't keep borrowing more money. But he said, your clean cards isn't gonna work. And I said, why not? It'll have some advantage. This drives a market. You get some competition out there. You identify the good guys. And he said, you've got to understand, if we had to tell them how much these things cost, nobody would use them. And I sat on the plane on the way back, and I thought, it's true. No one can jump in a market in which the game is all about pretend to give it away for free, knowing you're going to hit them on the back end. Nobody can be the first one to say, this thing actually costs 17%, and put that right up front. And no matter how many other good people say, at least kudos to you, you explained how much it costs, they're not going to pick up any business when everybody else is doing it at 2.9%, or so it seems on the front end. And lest that lesson not be driven home hard enough for me, I'll just tell you 2 quick stories in succession. The first one was when we were debating the CARD Act back and forth about 3 or 4 years ago. There was a big issue back and forth about universal default. And that was something that was ultimately outlawed in the CARD Act. Universal default just says if you get into trouble on anything, the credit card company can raise your fees, even if you've been making those payments on time in full under your contract. And a lot of people thought that was fundamentally unfair. So there's a lot of bad press around it. One very large credit issuer stood up and made a huge public declaration. We hereby renounce universal default. And Congress people stood up with executives from that card company and said, this is the way it should go. This is the market repairing itself. This shows you that markets can discipline themselves, that markets can heal themselves. Great. You couldn't ask for more press around it. It was more than I was ever going to be able to give with clean cards. What happened? Within a matter of months, that same company had to push some poor, hapless vice president out the door to announce as quietly as humanly possible, the company has resumed using universal default. And the interesting part about the why is the explanation that followed. This is a paraphrase, but what it basically said is these damn things have become so complicated that when we made ours a little bit cleaner, nobody could tell the difference. So all we're doing is just giving up revenue. A competitive market causes us to continue to issue the dirtiest possible product. So I figure we got to do something else. And that means the something else we got to do, my suggestion was that we go to the consumer agency. The idea here is that you've got one agency in Washington that's really just pushing for a kind of basic principle, and that is that the same set of rules apply to all issuers who issue a particular consumer credit product, and you get them all in one place. So that means if you've got a mortgage, the rules are going to be the same. If you've got to take out a mortgage, the rules governing that mortgage will be the same, whether it was issued by a state-chartered bank, a federally chartered bank, or no bank at all, a mortgage broker. It's going to be the same in terms of the kind of disclosure we do, whether you're borrowing money on a credit card, whether you're doing it by a check overdraft, whether you're doing it by payday lending. If you're borrowing money, there ought to be some similarity in terms of the information that's given to the borrower and some comparability so that people can understand the price, understand the risk, and be able to compare those products and figure out which ones are cheaper, which ones are more dangerous, and which ones they want to do business with. So what this is really about is this new agency is to say, I actually still believe in markets. I do believe in markets, but I believe that the role of government is very important. The role of government in markets is to make sure that the competition is the visible competition, the competition that's out front. In other words, make the price clear, make the risk clear, make it so the products are easy enough to compare one to another, and then knock yourself out on competition. Do it on price. Do it on customer service. We are the bank where you can reach a live human being. Do it on services. Do it on cool iPhone apps. The point is, move competition not into the back. What's one more trick you can hide in the shrubbery, which is where competition was, to what is it that will attract consumers and add value for them? Because it is the role of government to make sure the competition is not occurring back in the hidden spaces. So what are we going to do with this agency? What are we planning to do here? Basic principle, make the price clear, make the risk clear, make it easy to compare products. And when I say clear, I mean real clarity. I do not mean a giant Where's Waldo puzzle. I mean simple, easy to read, straightforward terms. Make this competition work for families, not against them. So that's the first part of the insight about what this agency is about and about what role government should play in markets. It should push markets in the direction of saying compete. You know, I've used the toaster analogy once or twice before, but it really is worth noting here on appliances, on drugs, on any other thing that we taste, feel, touch, smell. The parts that are hidden, the wiring down in the toaster, the safety switches, what the quality of the wire is and the likelihood it will burst into flames, that's the part the government watches out for you. That's the part where, as a people, we engage collectively and say, yeah, we're going to designate somebody, the government, to make sure that everybody's following the same set of rules on that stuff. That nobody figured out, let's boost the profits by taking out the safety switches. Nobody said, let's boost the profits by using the cheaper wiring that's going to burst into flames. And then, where does competition go? Just like it has with toasters. You know, you can get orange ones, you can get silver ones, you can get ones that, you know, do lots of pieces, you can get ones that only do 2 pieces, you can get high-priced ones, you can get low-priced ones. Competition works, but it works against a background that makes sure that we are safe in that sense. So, that's the first part, but I want to say a second part about the role of government because it's become so clear to me as we've worked through this idea of an agency. Rules are not enough. They need careful and consistent enforcement. So I want to give you a small piece of this is to remind you, we have 7 federal agencies who have a piece of the consumer credit market. For none of those agencies is the consumer the primary focus or primary responsibility. It's always the redheaded stepchild at the picnic. Nobody actually wants to claim it. People talk about, yeah, we're going to do a little consumer, but the truth is, we're here to watch out for the profitability of the banks. We're here to watch out for monetary policy. We are not here to watch out for consumers. And so one of the central parts of what this consumer agency does is it not only talks about the same treatment between banks and non-banks, it also talks about the same treatment by pulling it out of 7 different agencies and putting it in one agency that actually cares about this and that is directly accountable to the American people for it. I think this is a really critical part of what happens in building, what we will be doing by building a consumer agency. It's that we actually get an enforcement force whose central issue is how do these products look from the point of view of the consumer? What are the rules? And if the rules aren't being followed, to come in and provide some real enforcement on that. We need a real commitment to consumer protection. It can't be half-hearted. Banks cannot be in a position, I don't know if you all knew this, to pick their own regulators, which has been the system up to now. And that the regulators, among the banking regulators, the OTS and the OCC, they get their budgets based on how many banks choose them. Ask yourself why consumer protection was not at the top of their list over the last couple of decades. That was the structure. So part of what I'm trying to say about this, and actually, let me do one more. The notion of what fragmented oversight means from another direction, and that is, think about this mortgage servicing scandal that we have just gone through. You know, as scandals go, this was like the dumbest scandal out there, right? This was not a Ponzi scheme where somebody said, we're going to pay you from the profits. And, you know, somebody could look at it and say, well, it kind of looked okay up until somebody did the accounting and dug into the books. Much of this is, there were companies that just decided it was cheaper not to follow the law. And they didn't follow the law. This is not, we needed fancier laws. This was not, if you dug deeper, you would have seen it. They did not follow the law. 4 years ago, there were academics, you are looking at one of them, who were talking about the fact that there were troubles in mortgage servicing. They were not following the rules before you foreclose. Katie Porter, one of my former students of whom I am very proud, got interested in this whole question and did a big study on it. She used the bankruptcy data. Bankruptcy data are fabulous. You can look at all kinds of things. And discovered, kind of through that lens, that mortgage servicers just weren't filing and creating the basic paperwork that they were supposed to create in terms of showing the chain of title, showing who owed, just kind of checking off the boxes on this. There were people who were waving their arms about this, and yet not one agency in Washington that gave anyone the time of day, that had the slightest interest in it, until the problem got bigger and bigger and bigger, finally hit the front pages, it's everywhere, and again, threatens the entire system, starts to rock the entire system before we could catch anyone's attention on it. When there's fragmented oversight, when everybody's supposed to be watching a little bit, nobody's really watching. And I think that's part of what broke in this financial system, and that's part of what we are going to fix with the new Consumer Financial Protection Bureau. So I'm going to stop there. I could talk about this bureau all night long. I could. And I could do it for the same reasons that Joanne Alter could talk all night long. We believe in making changes. In my case, I'm going to keep driving for an agency, driving for an informed consumer, driving for someone who is going to say, no matter how powerful the institution, or not powerful, how much it figures out how to hide on the corner and nobody can find it, or on the internet, all the different tricks. No, this is not going to work anymore. We're going to make these markets work better and make them work better for families. We are not going to have a repeat of the most recent financial crisis, at least in the division of bringing down the American families. We are not going to do this anymore. We are going to wind down the financial stress on middle-class America. America's middle class is in deep peril. I chose public service at this moment because I believe that Americans deserve better. We deserve a financial system that works, not one that's stacked against hardworking families and that puts so much risk into the larger economy. We need rules that work for all of us. The recent financial crisis was a reckoning, a profound moral testing. Our security as a country rests on whether we can design a suitable set of laws that work, not just for the powerful few, but for all of us. Whenever our country has faced economic reckonings in the past, government has played a vital role in course-correcting actions, providing a way forward that serves the common good, one that gives us our national identity and that makes us stronger collectively. Women have historically provided key guidance at these junctures, with Joanne Alter representing an inspiring example. Women are needed now more than ever. With the new Consumer Bureau, we have a chance to make an enduring and significant contribution. So I follow Joanne in saying, I'm ready to do my part.
All right. You managed to make bankruptcy and credit cards sexy, and that's not easy. We've got a lot of wonderful questions from the audience, and they're very substantive questions, but I wanted to kind of start out with one from Gwen that I think goes at some of what's going on in people's minds when they hear somebody as dynamic as you talk. The question is, with government so steeped in bureaucracy, how can one person try to make a difference? How do you break through all of the obstacles to get your voice heard?
You know, I wish I had an answer. I just speak for the people who speak to me. We are having such fun building this agency. I really do. I feel like Bob the Builder. We get to put pieces together. There are so many people who want to work on something larger than themselves, who want to make a contribution to something that's bigger. And right now, what we're doing at this agency is just offering that opportunity. We keep in mind a vision, what it is that we're working on. We keep in mind two things every day: who it is we work for. We reinforce this every single morning among the little group that gets to be the bigger group that gets to be the bigger group that's building this agency. We are here for the American people. That's who we work for. We don't work for the banks. We don't work for Wall Street. We don't work for anybody else in government. We work for the American people. That's our job. That's our charge. Read our statute.
How long before you're all set up?
So we'll always be in the business of building, but we are supposed to go live on July 21st of this year. That'll be exactly 1 year to the day after President Obama signed this into law. And at that moment, we take over from the other 7 agencies, and we now have the responsibility to do the rule writing and to enforce the laws that are already out there in the federal scheme.
A lot of people want to know whether you'll be the first chair of the Consumer Bureau.
So do I.
Okay. There's some people in Chicago who have a little influence with a certain gentleman. But this really goes to a deeper question about President Obama that dovetails with John's question here. He asked, do you feel we are in the midst of a class war in the U.S., a war on the middle class by the top 1% of wealthy Americans? And I think if I can, John, ask a slightly more vague version of that question, less pointed. Should the Obama administration be working with the financial sector in a collaborative way, or is this inherently going to be an adversarial process where he needs to, and the new agency needs to, call out the miscreants and not try to pretend that we can all sing Kumbaya?
No. So I think that, yeah, you got to call out the miscreants. There's no doubt in my mind about this, but I really want to make a slightly different point. That doesn't mean it's war between the financial services industry and the middle class. We've got a real problem here, and that is the financial services industry itself is quite fractured. Now, I'm going to give you a couple examples of that. Community banks, by and large, they're not perfect. There have been some problems, but I got to tell you about community banks. By and large, they can't do front-end, back-end pricing games. Tell you they're selling it to you for one price and then plan to beat you with a 2x4 after they've gotten you to take the product, because they have real value in staying in the same community, and they deal with the fact that people tell them. They mention it at the the softball games and the PTA meetings, and they tell everyone else in the community. So community bankers, and I should add to that, credit unions, have had to build a model around being long-term partners with the families they serve. And there are a number of larger financial institutions who really want to do that. One of the most interesting parts about this job has been meeting with the CEOs of the biggest financial institutions and meeting with boards and CEOs from some of the tiniest financial institutions, even among the largest financial institutions. there are some who talk in terms of repairing their relationship with the American people. Remember the point I made about competition. When the game is afoot, you cannot be the one who started the game, but once the game is afoot and everybody else is offering it for free, you're no longer in a place where you can say, I'm going to make my cost clear up front. Indeed, I've talked to 2 CEOs that I can think of who said, I've put products out there that I know for a fact were cheaper than their closest competitors by a measurable number of points. And I couldn't get anybody to pick them up because I made my price on the front end instead of making my price on the back end. You are going to be my new best friend. You get out there and clean this market up, then competition starts to work. And there are other industries where actually this kind of notion has been out there. Think about it this way. Who's going to invest in doing it the right way if you can't make it clear because of everything else that you're competing against? So I actually don't see this as war in that sense. I see this as you have to call out bad practices for what they are. You have to say, here's the new rules going forward, and I'm going to say them till I'm blue in the face. It's about making the price clear. It's about making the risk clear. It's about making these products short enough and simple enough that people can make direct comparisons. You do that, I'm your friend. You don't do that, and I will fight you in the streets.
So if Jamie... If Jamie Dimon, who was a banker here in Chicago for a while, heads JP Morgan Chase, if he says in USA Today, as he did last week, that, with the new crackdown on debit cards, we're going to have to raise fees, to make up for that, to keep their profit margins at a certain point, you're saying as long as you have this transparency and these requirements that you laid out, it's not really up to the government to tell them when they can or can't raise fees.
So it is not the job of this new consumer agency to come in and say to a bank, lower that fee or raise that fee, or you're allowed to go to this point. Right. That's not our job, and it shouldn't be our job. Our job is to say you've got to make these costs clear up front. And then let's see what the market does. You tell me what you're going to charge for this, let me see if somebody else thinks they can do it cheaper. We'll find out. But the truth is, we're all better off if we pay for it, if we see what it is we're paying for. Because at the end of the day, nobody was giving this stuff away free. They were never giving it away free. They were always just doing it on the back end where nobody could see it.
This is a broader question from Tony that I think a lot of people are wondering about. Why should banks that don't make loans get federal support? In other words, shouldn't there be more strings attached to, in the past with TARP and in the future with various favors that they get from the government? Shouldn't banks be required to start lending more to small business instead of sitting on their cash?
So I'm just going to make a statement to the side about TARP, not in my role as part of now the doing consumer financial protection, because I think there's a deeper question hidden in there, and that is the question about what we should have done in the fall of 2008 when the world, it looked like, was about to go over the abyss. I think Congress did exactly the right thing when they passed TARP, and they made the very clear statement to the world, we will not stand by on our ideology about free markets and let this economy plunge back into the Stone Age. I think they were exactly right. In my view, where the mistake was made is when the money was handed over to Secretary Paulson. I understand it was done under emergency circumstances, and he decided to start shoveling it out the door on a no-strings-attached basis. I'll just tell you, I come from a world of bankruptcy. And bankruptcy really is about coming in emergency situations and saying, look, sometimes it's better to rescue things than it is to kill things off. Yeah, you owed the money. Better to get 80 cents on the dollar than to get 0 cents on the dollar by throwing this thing out. But what I also understood in a world of bankruptcy is you wipe out the shareholders. That's the point of being a shareholder. You get rid of top management because somebody has to be held responsible. And you say you need a new business plan. Even if it's only scratched out in one page, the importance of what's called distress financing or post-petition financing or financing once somebody's in financial trouble, of hitting all those, that you wipe out the investors, that you replace the top management, and you say there's got to be a new business plan, is part of saying the old way of running the world doesn't work anymore. This financial crisis was not a natural disaster. It was not an extraordinary snowstorm or a tsunami or an earthquake. It was people who set up financial institutions and followed financial practices that were risky and that put the rest of this country at risk. And that can't happen anymore, and we needed to say that from the beginning. So it's...
So now we're 2 years on, and we have a Congress, which if it came up today, TARP wouldn't get through the House. It's just composed of different membership. And we also have some different economic policymakers in the White House. Austin Goolsbee, who was University of Chicago professor of economics, is now the chair of the Council of Economic Advisors. Larry Summers has gone and been replaced by Gene Sperling. Do the changes either in Congress or in the White House materially impact what you're trying to do?
You mean on the consumer agency now? Or
on the implementation of what you're working over at the Treasury, which I think not everybody knows. But, on a day-to-day basis, as you're trying to implement this, get the appropriations that you need to implement it, and have the access to policymakers inside the White House that you need to implement it. There have been some changes, and how do they stack up?
So the answer is there's one change that hasn't been made, and it's the one that mattered the most. This past summer, the president called me in, and after the bill had been signed into law, and after, the hello, he took both my hands in his and said to me, do we have a strong enough agency? Did you get what you need to get the job done? And I said, yes, Mr. President, we do. We've got the pieces we need. And he said, you're sure? You've got enough. And I said, if we can hang on to what we have here, we have enough. This mattered to him. It still does. And he said, this is an important part of my legacy. As long as the President of the United States stands behind this and we've got the tools we need, my view is I just keep building this agency and I just keep moving forward. And the rest of it, they're firing live ammunition over my head. I'll try to stay down. But I'm building every single day.
He does go back on this issue to when he was working down the hall from Lisa in the Illinois State Senate. Tell, if you could, the story of when you first met Barack Obama at Harvard Law School.
Okay. So I got an email, my husband and I both did, from one of our colleagues who said, there's another one of our former students who wants to put together a committee to explore whether or not he might be able to run in the Democratic primary for Senate in Illinois against an incumbent. And I like to go to these things for our former students. And so we put in a whopping $250 and went over late afternoon to David Wilkins' house. And the physical part of this is actually the most fun part of the story. He has this house that has a big sunroom on the back that lets in a lot of light. And it was late afternoon. And so I walked in the front door. There were, by the way, I think there were 6 people who came to this party. And, this is like my one time I bought Microsoft at a penny, And I look back, and here's this tall, slim man, you're going to love this, who's backlit. And he just sort of glows in the light. And I walk down the hall. I actually don't know who this is. And I'm walking down the hall, and he turns around and holds his hand out. And as our hands meet, he leans forward and says, "Predatory lending." I swear to God. And I went, and he said, "It's predatory lending. This is why I need to go to the United States Congress. I've tried to deal with it in the state legislature. I've tried to deal with it in state laws. The federal regulators are holding us off. They won't let us act to protect our own citizens. I've got to be able to move to Washington to do something about predatory lending." He went on and on and on. And I'm still just standing there with my hand. And finally gets all the way to the end. And then he says, with his great smile, "Well?" And I said, "You had me at predatory lending." It's true.
Okay, so the president has a lot of people in this room as well, but Christy asks a good question. So what can you ask this captive group to do tomorrow to help you help America?
Okay, two things. I don't want just one. I'm not getting paid for this. I'm not getting out of here without two asks. The first one is, there's a dust-up right now about the consumer agency. Bear with me for a second on funding. All banking regulators, those who have to stand up to the big, powerful financial institutions in this country and say anything to them, have always been independently funded. That means outside the political process. Now, like I said, there's a little twist in that. Some of them got their money from the banks, but the banks had to choose at least one regulator and be in the system and pay. The Fed gets its money, of course, from selling treasuries. They're outside the political process because of lobbying, because of political influence, and this has always been the case. The consumer agency is set up in what I believe is a profound statement of poetic justice, and that is, here's how I interpret the law. Congress said to the Fed, "You were responsible for dealing with consumers and protecting consumers for many decades now." And it's true, if you go back and read the statute, they should have been. They should have been actively involved in the mortgage crisis. They had the laws to head it off. And they failed to do so. So Congress said, from the day Dodd-Frank is signed going forward, you must tithe 10% of your income to consumers, and that will become the budget of the new Consumer Financial Protection Bureau. So we get the tithed money, and it keeps us out of the political process. There is a move in the House right now to try to pull us back into the political process, which, by the way, would add to the national debt, to put us back into the political process so that lobbyists would be able, year after year after year, to attack our funding. And the reason I think this is so important about what's going on, I don't think anybody's going to try to repeal the consumer agency. But if you can rip its arms and legs off so that it can't do anything, then you get the same effect. So the first to ask is email somebody powerful tomorrow, somebody who has a connection to Washington, and say, the consumer agency stays independent. That's the first thing. The second thing goes at this from a different point, and that is, I just want to mention about community bankers and credit unions. They fought the consumer agency, and I understand why. They are very worried about additional regulatory burdens. And they looked at this and just said, oh my God, this could be one more regulation. And we are already, think about it, they have to follow the same regulations as largely as a $1 trillion institution. A $1 trillion institution spreads that across a gazillion accounts. A community bank or credit union has got to spread that across a very small number of accounts. And so they've been very deeply concerned, and I understand that. I've been trying to reach out to community banks, to credit unions, because I think we should be partners with them. I think the kind of business model they follow is what we want to see for the American people. At the end of the day, I don't want to be part of a consumer agency that causes even more concentration in the banking industry, that causes us to end up with 3 or 4 quadrillion-dollar banks and nobody else, no diversity in this system. So if you have a connection to a community bank or a community banker, to a credit union, talk to them about the consumer agency and talk to them about what they're doing and what we're doing. We should be together on that.
And
I could use your help.
Explain briefly how we can do this and do it for the troops, which just helps politically, with Mrs. Petraeus.
So one of the best parts of doing this agency is that you get to see a lot of people who really care about this set of issues, and who've lived different parts of it. One of the parts is what's happened to military families. Military families have often been targeted for some of the most abusive forms of credit. This has been true with payday loans, title loans, but also with certain kinds of mortgages. And military families, of course, face certain challenges about being moved around. Families, now we're getting 2 couples who are both military, and they get sent to different places, a lot of special challenges. I was on the job a week when Holly Petraeus came to see me. And sat in my office. She was working for the Better Business Bureau on a military outreach initiative on credit, and started lecturing me. There's just really no other way to describe it. Started lecturing me on the loopholes in the law that needed to be closed and better enforcement of the laws. And by the way, online, what are you planning to do about that? They're targeting military service members. And you know, by the time she took her 3rd breath, which was a long way into her conversation, I thought, this is a woman who should come work for this agency. And so Mrs. Petraeus is now the head of our Service Member Affairs office. And she's terrific. I am also pleased. I want to say this because this is what you really need to understand. She gets it. I mean, she was military. She grew up in a military family. Her father was military. Her grandfather was military. This goes back for a long time. Obviously, her husband, General Petraeus, her son is in the military. But she gets what's happened to these families, and she is deeply and profoundly passionate about it. And I want to say this. She is like the other people who work at this agency, who may not have such famous names, but all of whom believe that what we're trying to do is we're trying to do a little good in a very dangerous world for some families who really, really need it. So thank you for the opportunity to talk about it.